Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for being here. Volatility and uncertainty continue, led by monetary policy and the continued tightening by the Federal Reserve. So recession fears clearly are plaguing the markets. So where do we go from here? So joining me now for this discussion is Octavio Morenzi, co-founder and CEO of Optimus. Octavio, thank you so much for joining us. Clearly, we are in that period in the markets where we're at a bit of an inflection point. So the question of where do we go from here really does dominate, I think, our conversation for today. So thanks for being here.
Well, thank you very much, Anthony, for having me.
Good. Thank you. Thank you so much, Octavio. So let me start, because the first thing, obviously, that everybody wants to talk about is what's going on with the Fed. So we know that they raised the federal funds rate 75 basis points at the recent meeting. The target is now 3 to 3.25%. And they have announced that their goal is just under 4.5% by the end of the year, which means more hikes are on the way and possibly into all the way through 2023. So here's the question, Octavio. What could Jay Powell start to, what could he do to start to change course and either pause rate hikes or even start loosening? What does that look like?
Well, I think Jay Powell has laid it out very, very clearly and unusually clearly for a central banker. I'm used to reading sort of between the tea leaves in terms of what these different heads of the central banks around the world said. He's been perfectly and brutally clear. He said, we need to get inflation back below 2% or at around 2%. That's the Fed target rate. It's gotten away from us. We want to prevent that getting out of control. And we're willing to take into account quite a bit of pain economically in terms of unemployment and in terms of the market to achieve that. So that seems to be, at least how he's articulated, his number one concern. And before inflation is clearly on the way back down to 2% or gets the 2% per year, I don't see him letting up. So we're going to see many more rate hikes come. And we talk about 4.5% by the end of the year. I fear that we're not going to get inflation under control by then, that there's other factors in the economy going to drive inflation even higher than we've seen so far. And he's not going to be able to let up for some time to come. So I see more pain coming.
And that's exactly what I think. Clearly the markets are remaining volatile. Equity markets are declining, which we're going to get to a little bit later. But let me ask you this, Octavio. In your opinion, what level of the Fed funds rate do you think the U.S. economy could withstand? And when do you think it's going to be, okay, we're just tightening way too much here, and they need to start either freezing or start to loosen monetary policy?
Well, I think you're starting to see the damage of the high interest rates already. There's this ongoing discussion that I find a bit weird is, are we in recession or not already? I mean, we've had two successive quarters with negative GDP numbers. For most people, that's the definition of a recession, but some people are still trying to figure out, are we in a recession or not? Aside from the sort of the technical definition of the term, I think it's clear that the economy is doing badly, it's slowing down, things are not looking good and impressive. And I think the main reason for that is there are large sectors of the economy that have become basically addicted to this ultra cheap money, these very, very low interest rates. And that might be knowingly or unknowingly, because some people might just stumble into that and their business model might require that. And now those business models no longer work. And you're going to have to find a different approach in terms of financing things, in terms of how much you can borrow or not borrow, and readjust there. So the economy is in for some pain on that front, simply because we've had such low interest rates for so many years. And now that's unfolding and unraveling. And we have to find a different way of approaching things. And that's going to be painful for some time while things readjust. And I don't see any way around that. So how much pain can we stand before Jay Powell says, okay, I'm going to lower interest rates again? He said quite a bit. So he said he's willing to see interest rates keep going up, the economy do badly, and unemployment not go through the roof perhaps, but he's going to tolerate that for quite some time to come.
And you talk about recession, and you can't really ignore, you mentioned 2 negative quarters in a row of GDP, which by definition, if you look at the textbook, is recessionary, but also the yield curve inverted yet again. 2 years hit a high that we haven't seen since October of 2007, just ahead of the Fed meeting, while the 10-year was at around 3.5% at that moment. So you've got yield curve inversions, you've got 2 negative quarters in a row. Isn't that enough for us to say, here are the indicators that really indicate that we're in a recession right now? What do you think about that?
I would agree with you. I would say if I were deciding these things, I would say yes, we're in a recession. Now, I don't know whether it means that much, whether we say yes, we're in a recession or not in a recession. I think the fact is the economy is not doing as well as it has done previously, and it could be doing much better. So I think that goes without saying. So I think probably yes, we are in a recession, whatever you want, however you want to define that term. I think the two negative successive quarters of GDP growth, I think, are sufficient for me to say yes, it's a recession. But so where do we go from here? And yes, we've got the yield curve that's now inverted, and the major reason for that is that the Fed tweaks basically its interest rates on the short term. So we've seen short-term interest rates rise a lot more quickly than longer-term rates, and that has created this inversion of the yield curve, which typically is also a harbinger of a recession and some economic difficulty to come. So those things sort of are very clearly aligned. The question is, how far can they go, and how far will they go on this? I would say they have a lot further to go. So far, the Fed has basically been tweaking interest rates by manipulating the Fed funds rate. I say manipulating, that sounds so ominous, but basically that's the interest rate they control most directly. And they're still sitting on a very, very large portfolio of bonds that built up, close to 8 trillion. They've trimmed it ever so slightly over the course of the past 6 months. So they've sold some of their US treasuries. They've drawn that portfolio very, very slightly down, but they're still sitting on a huge portfolio of mortgage-backed securities that they've said they're going to start to sell into the market. And that will have the effect of depressing mortgage-backed securities directly, which means higher rates on mortgages. And that is going to punish, I think, the housing sector even more than it has so far. I mean, we're seeing 30-year mortgage rates above 6% now. I fear they're going to go higher. I would not be surprised by the end of the year to see 8 to 10% interest rates on 30-year mortgages. And that is going to crush the housing sector and really bring down prices there quite significantly eventually.
Clearly, we're not at those levels where we saw in the late 80s when we were getting something like 15 or 16% on 30-year mortgages. But these are levels that you're talking about that many people have not seen in their adult lifetimes. I think it's going to be a bit of a shock, as you just mentioned, to the housing market. We might see a little bit of a pullback there. But obviously, housing is one sector that is very impacted by the rise in interest rates. So from the equity side, let's go into the equity story here, Octavio. Where do you see sectors kind of actually performing well based on the rise in interest rates, and which ones do you see, besides what's going on or potential for housing, where you think there might be some tough times ahead, depending on where we see as far as these interest rates as high as they can go?
Well, I see tough times across all sectors. I don't think there's any asset class, even aside from equities, but outside of equities more broadly, any asset class that really is going to come away well from this, be it gold or commodities or corn or oil or anything. All these prices have been driven up by a decade or more of a very, very loose monetary policy by the Fed and, in fact, by central banks around the world. So that's driven all these commodity prices up into sort of, let's say, bubble territory, if you will, and that is now unfolding and being pricked in front of our eyes. So that's all going to come down. So I don't think there are any sectors that really are going to do well at this. I can point out one or two sectors that I think are doing particularly badly, and that's going to be the tech sector. The tech sector always suffers more. It's very sensitive to interest rates because so much of the earnings potential is out into the future. So as interest rates rise, those things get discounted more. Just mechanically, the stocks become worth less. I think another sector worth highlighting is the whole banking sector and financial services. It was not so long ago that some very smart people were saying, well, higher interest rates are going to be good for banks because they earn money on their loans, and the higher the interest rate is, the more money they earn. And that sounded kind of plausible. But it's not really the case because they don't earn their money just directly off the interest rate, but on the difference between short-term rates and long-term rates, i.e. the steepness of the yield curve. And as you pointed out, the yield curve is inverted now, and that's really bad for banks' lending activities. It means they have to pay more to depositors than they can lend it out for in the longer term. So that is a very, very bad omen for the banking sector as well. So far from being a positive sign, the way some people pointed out last year, that higher interest rates will benefit banks, we're seeing quite the opposite, and bank stocks are being punished as a result.
Yeah, and obviously if we see a major correction on the equity side, it's tough to see where there may be some advantages here. So, Octavio, thank you very much. It's a bit of a sobering conversation, but one that we clearly need to be having as we're going through this journey of where we're headed, between the Fed, the markets. Obviously, there's still geopolitical concerns out there with the war in Ukraine, so there's so much. And we used to have midterm elections here in the U.S. just to add more to the pile of things that we need to be talking about. So glad you could drop by, and good to see you.
Thank you so much, Anthony.
Great. Octavio Morenzi, co-founder and CEO of Optimus. Thank you so much, Octavio. And for more information from UBS, you can visit our website at ubs.com/views. Plus, we're on social media, LinkedIn, Facebook, Instagram, and Twitter. And you can take a look at all of our past UBS Trending episodes on demand through our website as well as the UBS YouTube channel. And as always, if you have any questions about your portfolio or anything we spoke about with Octavio today, please speak with a financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.